Crude oil prices experienced a sudden and significant spike late Monday, a jolt that reverberated across trading screens worldwide. This surge followed a stark warning issued by former President Donald Trump. His message, disseminated via social media, specifically urged citizens to immediately evacuate Tehran, raising alarm bells across international circles. This urgent call came amid already escalating tensions between Israel and Iran, a geopolitical crisis that has kept markets on edge. Traders, already in a state of heightened anxiety, interpreted this warning as a clear sign of imminent conflict, a potential powder keg in the Middle East. The primary concerns centered around the potential disruption to crucial oil flows, particularly through the strategically vital Strait of Hormuz, a critical choke point for global oil transportation. The market, which had shown signs of calming after a period of volatility, experienced a sharp and immediate reversal. Trump's grave warning forced a rapid and widespread reassessment of risk across the energy sector. His direct and unambiguous message, "Everyone should immediately evacuate Tehran," was immediately interpreted by market analysts as a precursor, potentially signaling possible U.S. military involvement in the escalating conflict. This prospect sent oil prices soaring to new heights. The warning itself followed a reported Israeli attack on Iranian targets, further amplifying existing fears that the window for diplomatic solutions was rapidly closing. Almost instantaneously, the market priced in the very real threat of a major supply shock impacting global crude oil availability. This reaction demonstrated just how quickly geopolitical headlines, particularly those carrying the weight of potential military action, can trigger significant movement and volatility in global energy markets impacting economies worldwide. The Middle East's dominance in oil reserves and exports is a well-established fact, holding a significant portion of the world's proven reserves. This concentration of resources gives the region immense influence, makes it the heartbeat of global energy markets, the central nervous system through which the world's energy supply is regulated and traded, and a flashpoint for price volatility, where even rumors can send prices soaring or plummeting in a matter of hours. Any instability, especially involving Iran, a major player in the region's oil production, threatens not just its own output, potentially reducing the global supply of oil, but also the critical shipping lanes like the Strait of Hormuz, a narrow and strategically vital waterway through which much of the world's oil flows, acting as a crucial artery for global energy distribution. Even the hint of conflict prompts traders to add a risk premium, an additional cost factored into the price of oil, fearing a cascading supply crisis, where disruptions in one area can quickly ripple outwards, impacting the entire global market. Trump's warning played directly into these anxieties, tapping into existing fears about potential disruptions in the region, suggesting a conflict that could spill into the Persian Gulf, further escalating tensions and threatening the stability of the region, and disrupt global supply, potentially leading to shortages and price increases worldwide. The market's swift reaction to both Israeli strikes, and any sign of military action in the region, and Trump's rhetoric, highlighting the power of political statements to influence market sentiment, shows how tightly oil prices are linked to Middle Eastern geopolitics, demonstrating the intricate relationship between political events and economic outcomes. In this region, political statements instantly become financial consequences, translating into tangible effects on the global economy, for consumers and industries worldwide, impacting everything from the price of gasoline at the pump to the cost of manufacturing goods. The impact of Trump's warning was immediately clear in the numbers, showcasing the market's sensitivity to geopolitical events. Brent crude futures experienced a notable surge, rising to $73.46 a barrel, reflecting concerns over potential supply disruptions. Simultaneously, West Texas Intermediate also climbed, reaching $70.58, mirroring the upward trend in global oil prices. These gains effectively reversed earlier declines, demonstrating the market's rapid response to new information. These declines had occurred when hopes for de-escalation briefly pushed prices down, creating a short-lived bearish sentiment. Before the warning was issued, U.S. crude had dropped by 1.66%, indicating a move towards lower prices. Similarly, Brent had seen a decrease of 1.35%, reflecting a general easing of tensions at the time. This was largely driven by reports suggesting that Iran was looking to avoid a wider conflict, which initially calmed market anxieties. However, the president's post swiftly erased those losses, underscoring the power of political statements on market behavior. This highlights just how quickly market sentiment can swing from a sense of relief to palpable anxiety, especially in such a sensitive environment. The initial Israeli attack had already caused the biggest single-day price jump in over a year, setting the stage for increased volatility. That jump was a substantial 7.3%, a clear indication of the market's immediate reaction to geopolitical instability. This surge effectively set a new higher baseline for oil prices, suggesting a sustained period of elevated trading levels. Each subsequent price move reflected traders' ongoing attempts to accurately price in the latest risks and uncertainties. And increasingly, social media posts are becoming a major and immediate driver of market sentiment and price action. The numbers, when viewed collectively, tell a compelling story of market dynamics. It's a story of hope, fear, and pervasive uncertainty, all battling for dominance in the minds of investors. These emotions are all playing out in real time on the world's energy exchanges, influencing prices and shaping the global energy landscape. In crises, trader psychology often outweighs hard data. Fear and speculation drive prices as much as actual supply changes. Trump's urgent emotional language bypassed rational analysis, triggering a rush to buy oil futures as a hedge against disaster. This herd mentality, where no one wants to be caught on the wrong side of a price spike, amplifies volatility. The market's reaction was broad and immediate, as traders scrambled to avoid catastrophic losses. Earlier, hopes for diplomacy had prompted a sell-off, but Trump's warning instantly reversed sentiment. The emotional weight of his message overpowered logic, sending prices climbing as traders shifted back to defense. In volatile times, fear of missing a second chance for peace can be a stronger force than any economic indicator. Just as quickly as tensions can spike prices, signs of de-escalation bring relief. Earlier Monday, news that Iran wanted to avoid further conflict led traders to unwind risk premiums, sending crude down over 1%. Even Trump acknowledged Iran's signals for peace, fueling a brief sell-off as hopes for stability grew. This episode shows how headlines and diplomatic signals can move markets as much as physical supply and demand. Investors constantly search for off-ramps from crisis, eager to return to normal pricing. But as the day proved, a single warning can reignite fears and volatility, making risk management a non-stop challenge. In the end, oil's price is shaped as much by politics and psychology as by the barrels themselves.